All right, good morning, everyone. Hope you are doing well. It is time to do our weekly market analysis. Usually we would do this on Sunday, but since Monday is a holiday, we are going to do it today. So hopefully you're doing well. So let's go ahead and dive on in. 8 straight weeks on the upside for the S&P 500. It is the longest winning streak since December of 2023. The Dow Jones crossed back over 50,000 and closed at a record high. The Nasdaq hit 26,343. Q1 earnings came in with about an 84% beat rate, and that's against a 10-year average of 76%. So the aggregate earnings grew 28% year over year, and that is the strongest quarter since Q4 of 2021. So we've had a pretty darn impressive quarter on the earnings altogether. So pretty good stuff. On paper, yeah, it's one of the cleanest macro weeks that we've had of the year. And yet, yeah, consumer sentiment is sitting near a generational low. Manufacturing fell sharply into contraction. Long run inflation expectations have made one of the biggest 1 month jumps in recent memory. Credit is still below the key level it broke 3 weeks ago, and Nvidia reported an impressive $81.6 billion in revenue on the quarter. It beat on every line, and that's just an impressive number, to have in just 3 months. They made $81.6 billion in revenue, and yet the stock went down. So we have two true things going on at the same time, and that's what we are dealing with. And this week I want to walk you through all of it: the index picture, the Nvidia reaction, the credit situation, sector rotation, and what PCE Thursday means for everything. So let's get into it. The first thing I want to talk about is, of course, Nvidia. And let's start with Nvidia because it is the story of last week, and it sets the context for pretty much everything else. Wednesday after the close, Nvidia reported revenue came in at $81.62 billion against the consensus of $78.5 billion, beat by about 4%. Data center pulled in 75 of that billion, and that was well above estimates. The adjusted EPS was $1.87, and that was against $1.75. The free cash flow hit $48.6 billion for the quarter. Blackwell has pretty much been adopted by every major hyperscaler, cloud provider, model builder. We have Vera Rubin, which is the next generation architecture that is on track for Q3. So by every measure, that's a blowout quarter. And yet, yeah, the stock fell. The stock fell, and that's really 3 consecutive quarters of beating estimates and selling off in the days that followed. And the options market, they priced in a 7% move going either way, and the stock has done okay since then. So the February pattern pretty much held. Now, this doesn't mean that Nvidia is in trouble by any means. What it means is that the stock has already priced in an exceptional quarter before even having this print. So delivering wasn't enough. When a stock has run 57% since last June and another 20% since another 20% heading into this earnings report, a beat and raise needs to really be extraordinary to move things higher. So the bar had pretty much outran results. And I do want to show you the semiconductor chart. Let me pull that up real quick, and I want to go to the weekly time frame here. And the semiconductor ETF, it closed at 576.32 after touching a new all-time high of 582.50. And if you look at this weekly chart, every major trend is fully bullish. Momentum is at its highest readings. The internal breadth on the weekly is at an extreme level. meaning that it's not just price making new highs, it's the stocks inside the SMH that are broadly confirming things together. The hourly pulled back from the highs after the Nvidia print, but the internal breadth of everyone else is pretty much stayed strong. We're at 96 out of a score of 100, so that's still pretty impressive. So when you look at this, the semi-trend simply is not broken by any measure. What happened to Nvidia after earnings is simply digestion rather than reversal. The stock ran into the print, and it's just simply given some back if we really want to look at it here. Let that load. Maybe not. Let's see if anyone else wants to load. Maybe it's just TOS. Hang on one second. There it goes. Yeah, so as we can see, we're still holding above this 212.19, which is the prior breakout level. It's still looking pretty decent by all means necessary. Let me do that real quick so we're all aligned here. All right, but yeah, as you can see, the weekly squeeze here is still doing pretty good. And as long as we hold 212.19, I think we're okay. We're about to retest the daily 21 EMA. As long as we don't break down back below into this range, I think everything is still pretty good. Now let's bring out the MAGS composite here. This is your MAG 7 ETF. And this chart is pretty much telling the same story at the leadership level. For 6 consecutive weeks, this weekly chart has shown a momentum configuration where the short-term line has crossed above the longer-term line in a pattern. I've been flagging every week. The daily is modestly positive. The hourly faded into Friday's close, like I said. The leadership group is still intact, but sure, it is stretched. And Nvidia's reaction after an 81.6 billion quarter is the clearest evidence of that. So when a blowout quarter doesn't move a stock, the stock has priced more than the fundamentals can currently deliver. Let's go on to the index picture here, starting with the SPY weekly. SPY closed on Friday at 745.64 after touching 749.53 Thursday. It is fully bullish across the weekly, daily, and hourly timeframes. All 3 moving averages are stacked in order with price above them. The weekly momentum is at an extreme reading here on the oscillator, but this is the cleanest SPY chart that we've had this entire cycle, 8 straight weeks in a row. If we zoom in here to an hourly time frame, the hourly has improved significantly from last week's week close. Internal breadth is at 82.8. Last week, I did flag that that there was some short-term divergence with price making highs while internal soften. That divergence has closed this week. I did mention that was a possibility. And the hourly is confirming the weekly and the daily now. We got a bull score here of 80%. We did have that hourly squeeze prior to the upside. We got a new signal on the daily. And, some bears out there, of course, are going to say, well, this is possibly a potential double top. Of course, we won't really get confirmation of that unless we break below 731.70. So it's still very speculative if this is even a double top. But as it sits right now, this is still a very strong chart. Let's move on to the Nasdaq daily chart here as we get set up. Yeah, a little bit of a shooter candle here. Again, that whole bear question, is this a double top? Well, we don't know yet. But the QQQ is at 717.54. The weekly and daily are both clean, fully bullish, no major issues. The hourly has softened a little bit after Nvidia's post-earnings dip, but the internal breadth is doing okay. The only soft spot on the QQQ right now is the hourly, and it's a small softness. It's not a breakdown. The Nasdaq trend is still very much so intact. We're still trading above all the key moving averages. Yeah, the max bull 100%. There's nothing extremely wrong here. Let's move on to the Dow, and we'll go to a weekly chart here on the Dow Jones. The Dow Jones max bull. The Dow closed at 506.12, and this is the chart that did change the most last week. We highlighted that it was struggling to make any significant progress over these past 1, 2, 3, 4, almost a full month here, and finally she broke out and closed over its prior all-time high. And yeah, like I said, for weeks I've been pointing that the Dow has been the laggard. The index had no pure semiconductor names. It's mainly heavy in industrials and healthcare, and those were struggling to keep up. But this week, the weekly trend reached its maximum bullish reading for the first time in this entire cycle. The Dow index crossed over 50,000 again and closed above that at 50,579. IBM had its best week in 25 years. I mean, just look at this candle. It's absolutely crazy. And that pretty much pulled the Dow with it. You know, the daily on the Dow is pretty much coiled. Is coiling from a fully bullish starting point, so that energy building could possibly be for another leg higher. The Dow is now fully participating in this rally for the first time, and that's a meaningful development for the overall breadth story. So hopefully this week we'll see a hold over this 505.30 level. Maybe we'll dance around it and consolidate. But I would like to see the Dow Jones continue to hold above 505.30 and continue to push on higher. If we take a look at the small caps on the weekly, let me go to a daily. I think daily kind of shows it a little bit better. IWM at 285.12. Last week, I called the break below 279.88 as a failed breakout. This past week, IWM recovered very strongly and got back above that level. It's now pressing toward the prior high at 287.58. The weekly trend is fully bullish, with momentum showing the kind of strength small caps haven't had since before the Iran conflict started, so that's a positive. The daily bull, is at 90% with that price range tightening. The hourly fell a little bit, but small caps aren't just riding this rally anymore. They're pretty much confirming it, and that definitely matters for the breadth reading. Let's jump to the RSP weekly chart here, and this is an important chart to take a look at. This is the equal weight S&P 500. Last week, RSP's daily had downgraded to a neutral position, and I called it a meaningful 1 week deterioration. This past week, it upgraded to its maximum bullish reading on the weekly and hit the same on the hourly. So we have multiple time frames where this is now sitting at max bull with a 100% reading, where we're all in agreement here. We're above the key moving averages. Momentum has shot up. So that's a dramatic single week reversal. The equal weight fully bullish means that the rally is spreading into the body of the market, and it's not just concentrating in the 10 biggest names. So when the equal weight and the market cap weighted are both fully bullish, the rally has a broader foundation. And the breadth numbers confirm it. The SPX A50R, which is the amount of names trading above their 50 simple moving average, jumped from 53.7% last week to 56.8% this week. And the SPX A200, which is the number of stocks trading above their 200 simple moving average, moved from 51% to 56%. And 2 weeks ago, fewer than half of the S&P 500 stocks were above their 50-day moving averages. So this week, or this past week, more than half are above both. And that kind of single week breadth recovery has historically extended rallies rather than ended them. Let's move on now to our credit. Let's go to the HYG, which is your junk bonds ETF. Let that load. There we go. 3 weeks ago, the HYG broke below 80, and I flagged that as the most important development in the market. This past week, the picture improved at the short-term level, but I do want to be precise about what improved and what didn't. HYG is at 79.91, and it bounced off of 79.23 all the way down here. Right here, we had this nice little bounce here, and the thing that I want to note is, even though that the hourly has turned positive and that's real, but if we look at the weekly and the daily, it's still deeply negative, right? The daily only improved from negative 40% to negative 30% here. We're still below 80. The structure hasn't healed. Remember, we want to see trending properties at least within the HYG, and we just don't have that yet, at least as far as the HYG. The structure hasn't fully healed, but what we have gotten is at least some sort of short-term bounce within a larger possible downtrend, and that is a meaningful distinction. If we go to the LQD, which is your investment grade bonds, the LQD is at 108.37, and it pretty much shows the same pattern. The weekly and the daily are still negative here. We can see them minus 100%. The hourly, though, again, same pattern, did turn positive 70% and neutral up. We're above the 21, above the 50. But stabilization, but it hasn't quite recovered at the structural level. If we then turn our attention to the TLT daily chart, it's at 84.68 after having this epic breakdown last week. The weekly and daily are still at its full max bearish score, minus 100%, but the hourly has turned bullish, right? Bull 80%. We've recovered some of these key moving averages, but we're still below 85.50. And the TYX, which is your 30-year yield, pulled back slightly from that 5% level. So it's the first positive short-term bond read that we've had in a few weeks. And my honest summary on credit is that it's stopped falling for a few days. The weekly and daily trends on the TLT, the HYG, the LQD, those haven't really changed. Sure, they stopped falling, and that's the real read. It's not a recovery. It's just a pause. One more thing on the macro side here. The April FOMC minutes confirmed what the bond market has been pricing in. The options market at the time of the meeting were pricing a 30% probability of a rate hike by Q1 of 2027. The median path now still shows 2 25 basis point cuts, but respondents have pushed the expected timing further out, and it's now looking like Q3, Q4 of 2026 at the earliest, and that's not even a guarantee. The odds are still kind of skewed, but the Fed is, and we also got, the new Fed chairman, Kevin Warsh, but the Fed is not going to move until it has to. So you have to keep that in mind, especially as you look at something like the TLT. When we look at the macro data, the week gave us one clear piece of good news and a handful of things worth watching. The good news, at least, is the Atlanta GDP now is at 4.3% Q2 annualized growth. We had jobless claims at 209%. Pending home sales continue to be robust. We had plus 1.4%. Q1 earnings have been at 28% growth with an 84% beat rate. Nothing in the current data really says anything remotely about some sort of recession. But the things that I'm watching more carefully is definitely the Philly manufacturing that dropped from positive. Right, we were up here at 26.7 in April to now we're down to negative 0.4 in May, and that's a 27-point swing into contraction in a single month. New orders fell 35 points to negative 1.7, which is the worst since April of last year. Employment negative for the third time in 4 months, and the forward prices paid on the index jumped to 70, which is the highest reading since November. That's businesses telling us that they expect to raise prices over the next 3 months, and that's a forward signal on inflation. That's not a backward one. If we look at the University of Michigan consumer sentiment, that came in at 44.8 in May, and that just sits below the June 2022 historical trough. 3 straight months of declines. 57% of consumers mentioned high prices eroding their finances. Year ahead inflation expectations rose to 4.8%, and the long run expectations numbers jumped from 3.5% to 3.9% in a single month. A half point move in the long run expectations in 4 weeks is the kind of thing that historically takes quarters. So that's pretty impressive. When it moves that fast, the Fed is going to definitely take note of that, and you can pull up these graphs on the University of Michigan website there. The U.S. flash PMI, that came in at 51.7, and yeah, that sounds stable, but services came in at 50.9, and that's barely above contraction. Service exports fell at the sharpest rate in 6 years. Input costs have been jumping at the steepest pace since late 2022. The S&P Global's chief economist put Q2 GDP growth at around like 1% here. GDP growth not much more than 1% in the second quarter. But, the Atlanta Fed has it at 4.3%. So one of those estimates is going to be right. And then, of course, we have the whole Iran situation. Trump said Tuesday that they were in the final stages of talks. Rubio said slight progress. There's some optimism even going on right now. The Nasdaq futures are pretty close to hitting 30,000 if they haven't already. So yeah, that kind of covers our data from the last week. And let's go ahead now and jump into some of these sectors, because there has been some rotation, and that rotation picture has changed a lot this week. Let's look at the XLV, the healthcare. 2 weeks ago, this was not looking too good. It was actually looking pretty bearish. This week, the hourly has flipped. You can see here the daily has flipped to a 30%. If we go to the hourly, we can see that hourly has shifted to a more bullish, with the internal breadth at 93.6, and the daily upgraded from max bearish to that positive lean like I mentioned. The weekly is still modestly negative, but that short-term reversal from fully broken to fully bullish in 2 weeks is something real. Healthcare was Friday's best performing sector, up 1.2%. So there's that. So healthcare looking pretty interesting. Check out your favorite healthcare stocks. XLY, your consumer discretionary. This also strengthened. The daily is now at 80% bull. Is coiling in a compression here. As you can see, we do have a daily squeeze. Discretionary needs to show up for the equal weight to broaden, for that broadening story to make sense, and it has definitely showed up. If we look at the real estate ETF, this has also been upgraded to its max bullish reading of 100%. And that is on both on the weekly and the daily this week. 2 weeks ago, it was one of the worst performing stocks. It's rate sensitive. It was getting crushed. The TLT with that short-term bounce has driven it higher. And XLRE is one of the strongest sectors on the charts right now. Financials, XLF is probably the most interesting setup heading into this week. The weekly, yeah, is still negative, but the daily is definitely coiling. We are in a high compression squeeze, so it's very tight. Those Keltner channels are well within the Bollinger Bands, and we've gone from somewhat bearish to a neutral 50% starting point. So the hourly is also fully bullish here. If we switch over to that time frame, max bull, we just got to, see which way this daily squeeze fires. Hopefully we can get above 52.6 and get above that daily 200. And if PCE Thursday gives the bond market relief, the XLF is definitely going to be one of those sectors that possibly moves the most. So definitely keep an eye on XLF, especially on Thursday. If we look at IYT, which is your transports is now fully bullish across the weekly, the daily, and the hourly, with crude oil falling to 97, and I think it was down to about 92. That's direct fuel for here. Lower energy costs go straight into the margins for airlines and trucking, and the weekly is coiling alongside the daily. So be on the lookout to see if transports break out over 83, especially with this daily squeeze, and also with the weekly compression here that is looking pretty positive as well. So IYT is something that's going to be on my attention this week. If we go to the IGV, which is your software ETF, remember software got beat up due to the whole AI craze that has been going on, especially with Anthropic and ChatGPT. All that software has still has structural damage on the weekly, but the daily has improved to a positive lean here, neutral up 60%, and the hourly is fully bullish. So software is healing. However, Salesforce does report on Wednesday, and that's the most important print for the AI software thesis this week. If Salesforce guides well on the AI-driven subscription growth, the IGV recovery has some more legs. If Salesforce disappoints, the idea that NVIDIA's AI demand is filtering down into software gets challenged, right? If we now turn our attention to gold and the dollar, I want to take a look here at the weekly chart. This is the GLD gold ETF. It's still in correction from the 509 high, and it has now taken it down 19% since those highs. The daily and the hourly are still deeply bearish. The daily less so, it's only minus 5%, but the hourly is still deeply bearish. The correction isn't done at the short-term level, but if we look at the weekly, it is coiling here, as you can see on the squeeze. And it's coiling tightly from a near flat starting point. That's the same technical setup that preceded the original run to 500. The weekly momentum inversion that preceded the correction has started to unwind. Gold hasn't bottomed by any measure that I track on the daily. The 403 level is the next key reference on the downside, but the weekly is quietly building a base for the next major move whenever it comes. So definitely keep this on your watch list. If we happen to break down below 403, you got the weekly 50 down here at about 385, so that'd be a nice little 15-point snag there. So definitely something to keep an eye on. If we turn our attention now to the dollar will go to a daily time frame here. The dollar is currently at 99, 2 consecutive weeks now of practically testing the 100 resistance without breaking it. If we look at the hourly, it's pointing down, and that could be suggesting that the let me pull this up. Yonk. All right, the hourly is actually, the hourly is doing pretty positive. We're at 75%. The question here is, if this starts to fall, that could be suggesting that it's running out of momentum on this bounce. Like I said, we've had stalls occurring around this 100 level, so if we get back up here, that could be a warning flag, but resistance is resistance until it's not. So if the dollar fails and reverses, that's going to be a tailwind for emerging markets, commodities, multinationals with overseas revenues. So we definitely need to continue to watch that 100 level, and that level is going to continue to be the tell. I've been talking about this for weeks now, so that's kind of like a repeater, so just kind of keep that in mind. Since we mentioned emerging markets, we might as well take a look at it. Emerging markets are at 65.88. The weekly is still fully bullish, with bullish extreme momentum. The longer term dollar weakness thesis hasn't really changed, but the daily and hourly have cooled as the dollar has tested 100. The dollar's behavior this past week is probably, or actually this week, the dollar's behavior this week is the most important variable for the emerging market trade. If the dollar stalls and rolls over, emerging markets gets another tailwind. If it breaks 100, EM's going to struggle a little bit further, but mostly, yeah, we're still in an uptrend. We're still above the key moving averages. Nothing too seriously concerning as far as the EM ETF goes. Let's now move on to this week's economic calendar. Obviously, markets are closed for the day. It is Memorial Day. Tuesday, we do have consumer confidence, and that consensus is around 92. We do have AutoZone and Zscaler to report. Wednesday is the big test for AI software. Salesforce is the most important print of the week. If Salesforce guides well on AI-driven subscription growth, the narrative that NVIDIA's demand is filtering into software holds. If it disappoints, that narrative gets challenged right at the moment the market needs it the most. Marvel Technology also reports on Wednesday, and that's going to be another read on the AI networking demand beyond the GPU layer. HP and Snowflake are going to round out the session. And then, of course, Thursday is going to be our defining number for the week. PCE inflation for April. The consensus is a 3.8% headline. It's not on here for whatever reason. Year over year, and 3.3% for core, both higher than the prior reading. If those come in at consensus, PCE will be at its highest level since May of 2023, and core at its highest level since October of 2023. The bond market has been pricing in 5% long-term rates for a reason. So a PCE number above consensus is going to give it more reason to be above 5%. A number below that consensus will definitely give the TLT short-term bounce some sort of structural foundation, and that will change the picture for financials, XLRE, and even credit. Also on Thursday, not to, fail here, we do have GDP, Q1 GDP, the second estimate. The consensus is 2.1% here. We also have durable goods, new home sales. We got Costco and Dell reporting on Thursday. And then on Friday, which I think it's because I don't have that, apply filter. Yeah, here we go. Let's see. On Friday, we do have... why'd you go back? This week. Yeah, here we go. Yeah, there's that PCE Friday. Here we go. Friday, we do have the Chicago PMI. That's what I was looking for. Chicago PMI, which is consensus is 51.2. So this week pretty much has a clear hierarchy. Salesforce on Wednesday, PCE on Thursday, and then everything else is practically context. The bottom line here for the market, if we look at the SPY weekly, and I want to be straight with you about where I land. We've had 8 straight winning weeks. We've had an 84% earnings beat rate. The RSP's at maximum bullish readings. The Dow's finally joining the party. IWM is recovering. Breadth is jumping from below 44% to above 56% in a single week. The bull case has been very right, and the charts are confirming it. I'm not going to minimize that. But alongside it, if you look at data, consumer sentiments at a generational low, long-run inflation expectations are up nearly half a point in 1 month. Manufacturing's in contraction. Credit's still below 80. The Mag 7 composite is showing its 6th consecutive week of that stretched weekly configuration, and Nvidia delivered $81.6 billion in revenue, and the stock sold off. So the market is definitely pricing in that we do get an Iran deal to be closed finally this week, hopefully. We're looking for a benign PCE, a resilient consumer, AI earnings to continue to compound, and that's a lot of outcomes right now to get right at the same time. So PCE Thursday really is the next real input. If it confirms the market's optimism, the rally has room. If it does not, the all-time highs become the level the market has to defend. One last look here at the HYG daily, just to nail in the hammer in the nail. Keep watching the HYG, right? We've had a short-term bounce. Sure, the structural damage is there. The credit market hasn't really given an all clear. When it does, I'll tell you. But until then, it's going to continue to stay on the watch list. And look, the trend is still ultimately bullish, right? The main thing that I've been hammering in week after week is that the setup is fragile. 8 consecutive weeks, no pullback. We haven't had a mean reversion to the daily 21 since this entire run has begun. Granted, we did get a little bit of that catch up as we traded a little sideways. We almost got the pullback that we were looking for to the daily mean, but we haven't gotten that. And especially if you look at the weekly time frame here, you can see that weekly 21 EMA is practically caught up to that prior all-time high breakout. So it's just a matter of managing risk as we continue to push into all-time highs, even on futures. Continue to ride the wave until the wave breaks, right? Be ready to play defense. The setup is fragile, yes, but the trend is ultimately bullish. Can it continue to go higher? Absolutely. Can we finally get a pullback? Absolutely. But we still need some more evidence. But anyway, I hope this was helpful to you. Every Sunday, I put out my full breakdown, and I do a midweek check when the thesis change. I put out my midweek report on Wednesday. I didn't get it done this past Wednesday. Had stuff get in the way, but all in all, I tried to cut out the noise, and I just look at the charts, and I build my thesis upon that and tell you what I'm actually thinking. I have the full written version of everything that we've talked about, and every level and every indicator read that is on my Substack. The link is in this description. It's completely free. I would appreciate it if you can hit the like, hit the subscribe. If you can, leave me a comment before you go. Let me know what you're thinking, what you're looking at. PCE is on Thursday. Is it going to come in hot, or does it give the bond market some breathing room? just let me know what you're watching, and I will see you on the next one. I appreciate y'all so much. Take care.